All right. Thank you, everybody, for joining. Good afternoon. Today's webinar is 7 ways to double your high-quality deal flow for private direct investing with our special guest, Richard Wilson of the Family Office Club. My name is William Mucker. I'm a client executive with Camaplan, and we'll pass it over to Richard in just a second after a brief introduction and disclaimer. Here is just put together by some attorneys to let you guys know that we at Camaplan, we're not attorneys, we're not financial advisors, we're not CPAs or tax professionals. We're a neutral third-party administrator of IRAs. We can't give any advice in any of those fields. So if you do need that advice, feel free to reach out to any of those professionals in those given fields, and you can get on a line with a Camaplan representative and one of those professionals, and we can make sure everything's going all right based off of their advice. We do not endorse anybody. We do not sell anything. Again, we're a neutral third-party administrator of IRAs. Everything in this webinar is strictly for educational purposes, and we always encourage you guys to do your due diligence before choosing any investments or making any financial decisions. If we'll go to the next slide, there you go. There's my contact information. William Mucker, client executive here at Camaplan. If you have any questions about today's webinar and how it can apply to self-directed IRAs, if you'd like to open an account and need any help, or have any questions about your account, if you already have one with us, feel free to reach out to me. I'll be happy to help. And without further ado, I'll introduce Richard. Most investors see just a handful of deals per year. And if you see just 10 deals a year, how many great top 10% deals do you have to choose from? If you can become more clear on what is an excellent investment for you and your family, you can then work to double or 10 times your deal flow. You can afford to only invest in the top 1% or 0.5% in deals you see if you get access to enough investments. He has found there are 7 distinct ways to double your high quality deal flow. And in this webinar, he will break down what they are and how to use several of these strategies yourself. Most of these strategies are free to use and practical to begin employing this month. Attendees of this webinar will get Richard's free book, How to Start a Family Office, the Single Family Office, and Centimillionaire Strategies, How to Turn the Top 6 Challenges of Ultra Wealthy Families into Points of Strategic Advantage. And without further ado, Richard, it's all you.
Great. Thank you. Appreciate you having me here today. I'm going to share my PowerPoint now, but I'd like to have this be interactive. So as any of you have questions, feel free to interrupt me and submit the questions via chat or in the Q&A panel. I'll try to keep an eye on that as I go. The point of this webinar is really to share strategies on how to see more investment opportunities. So you might not invest in more things, but the things you invest in are going to have lower risk and higher return. Some people say, well, how is that possible? Because when you have higher risk, you have higher return. Well, that's not the case. If that was always the case, there wouldn't need to be investment committees. They would just choose things that were low risk or high risk, and that would be it. But it's not that simple. A lot of things have hidden risk within them. A lot of things have more risk for one party versus another investor, because some people know how to de-risk a deal or evaluate a deal better and conduct more thorough due diligence. And when you see hundreds and hundreds of deals in a quarter and you only invest in 2, you get to find the exceptions to the rules, and you get to find the anomalies and the things which you can have the most confidence in and maybe help and maybe understand better than other investments. So my experience has been starting an organization called Family Office Club 14 years ago. We host 20 live events a year. We also work with 375 investors through InvestorClub.com. So every day I'm texting, emailing, and calling with my clients and the couple thousand investors we have in our Family Office Club. And after watching a lot of family offices start their organizations, whether it's a small virtual family office or a private investor who's worth $2 million or $5 or $10 million, or some of our clients that are worth a couple $100 million, a lot of them have the issue of not only not having clarity on what to invest in, but they're not seeing enough things within their strike zone or within the industry they're most interested in. And that leads to poor investment decisions. And oftentimes it leads to investing in a whole lot of startups, and they feel like they're getting some diversification, but they're just taking huge risk all over the place and just kind of shotgunning their money out into random projects that are almost all in the startup phase, sadly, a lot of the times. So obviously on this webinar or any other one you listen to for the rest of your life, you have to make sure that what we're saying makes sense for you, and you might need to seek counsel in terms of compliance or what's going to be appropriate or the right level of risk. It's not a generic investment recommendation. It's just a picture of some of the professionals on our team. Last thing I'd say about this is that we've met with over 3,000 investors in person over the 150 live events we've hosted. So a lot of the ideas come from those meetings. There's some free books we've given you if you want access to them on how to start a family office, Centimillionaire Strategies, a book on single family offices. You just let me know if you'd like a copy of one of those books, and I'd be happy to send you a link to them. We also have the Family Office Podcast, and familyoffices.com is one of the most popular websites in the industry. So the evolution of our understanding of family offices really started in 2007 when I started the club. And then we grew to not just focusing on generic, the family office industry, but started dialing into single family offices, which are basically ultra wealthy private investors. How to start a family office was the next evolution. And then while the mainstream media is obsessed with billionaires because it's easier to cover 2,500 people that are worth $1 billion plus than it is to cover 55,000 people who are worth $100 million plus. The centimillionaire marketplace is much more interesting for anyone raising capital. Billionaires are almost impossible to reach. And there's more centimillionaires and more ultra wealthy being created all the time. And so I think a lot of the family office industry gets publicity through Soros or Bill Gates or Warren Buffett, but a lot of the meaningful transactions get done and deals get done and things we learn from are from the $100 million net worth families, that then people like myself can use those strategies to become more successful and become more wealthy. So the things we do in our business, from getting deal flow to our business strategies and processes to our branding, are things that we learned from the $100 million net worth families, emulating what strategies got them to that wealth and what's growing them to the next level. And many of these things are applicable to someone who's even worth just $2 to $4 million. That's what this book was about, learning from working with these clients and what strategies they need to use consistently. Okay, so why focus on superior deal flow? We touched on this a minute ago, but if you can be the first one to see deals, then you could invest in the deal and secure your spot before it fills up. The fastest deals fill up within a day or two. We had a dental clinic deal recently. We were going to take it to our 72 dentists that we work with, who are all investors or sold their practices. And we showed it to a very loyal healthcare X-ray family that we've closed several deals with. We showed it to them first before going to the 72 dentists because we were already on a phone call with them. And they took the whole deal, and none of the 72 dentists even got to see the deal because the one client, took the whole deal first. That happens often. Someone will say, oh, well, me and my two partners could fill that deal, or we'll take that deal. And the deal's gone before it even gets close to being quote unquote on the market. So it's just the reality of great deals sometimes. You also sometimes can not just be the first, but maybe someone only needs one investor. We were on the phone yesterday with a consumer products company, and he only needs a couple of $100,000. And he said, you know what, I just want to deal with one investor, be one and done, and make it clean and easy. And from the very start, the intention is to close it with one relationship. So you want to be the first call for someone who has a deal that would be a good investment for you. The other thing is that you can respond faster when you see a lot of deals and know what you want, because you'll recognize what's an anomaly and what stands out versus what looks average. If you only see 7 deals a year, you might be less sure about your decision making. So you don't have a lot of data points or touch points to compare that deal to. The other thing, we'll get into a couple of the other benefits as we go through the strategies, but here is the approach that we like to think about visually when we think, how do we get great deal flow? We think about being in the right communities, the right positioning, meaning in the marketplace, people find you because you are investing in this thing, which might mean you speaking at an event or two, or being in a networking group, or branding your small virtual family office with a certain brand, or just being known as someone who likes to invest in manufacturing or in stem cell companies or in hard money loans. Those are things you can position yourself in, whether or not you made your money there. One of my clients made their money in a operating business, but now they've done 150 hard money loans, and they get referrals all the time to do hard money loans, and which is like a real estate lending strategy. So you don't have to be stuck at where you created your wealth. Being proactive, that means reaching out to potential companies or investment opportunities you'd want to get involved in. I can share a few examples of that later. Acquiring choke points, which means strategic bottlenecks in the industry, and how if you can acquire those, it can get you lots of deal flow over and over again. An example of this is last year we bought commercialrealestate.com, and the level of real estate deal flow we're getting right now is probably double that we were getting 12 months ago. And we're hosting quarterly real estate summits. So I believe over the next 2 or 3 years, we'll double that deal flow again. That's an example of a choke point, because once you own it, it's improving your deal flow, and it's lowering your cost to access deals. And it is also harder for a competitor to get that choke point after you've acquired it, because you're not looking to sell it. The other thing is to operate within the business. If you want to invest in dry cleaners or movie theaters or stem cells, having one business that operates within the niche that you run can help you with all of your other stem cell investments, because you'll understand the industry on a frontline basis. That can be a big advantage to getting access to deal flow, valuing deal flow, conducting due diligence, and just being known as someone with real expertise in the space. Everyone who has a stem cell company would rather, all else equal, typically would rather take on an investor who's already in the stem cell space and they get it, rather than try to teach somebody the ABCs of stem cells and promise them that their company is doing great things and is adding a lot of value. That turns into a waste of time for everyone involved a lot of the time. Here's a couple other things related to doubling your deal flow. The base summary of this slide is really that you can compound your returns when you only invest in things that are top 1% or top 0.1%. And you'll lose less money because you can choose the things that have more collateral behind them, are more local to you, that you understand better, et cetera. And that really compounds over time. And they show a graphic in a little bit about standard deviations. But essentially, if you look at what an average deal is, and then you look at what is a little bit outside of average, and then further outside of average, and then way out on the tip statistically of what you would see, you'll never be able to see those deals unless you get very lucky along the way, and you won't know when you're getting lucky. So the other message here is that over the next decade, there's going to be more capital than ever before. Just like right now, there's more capital than there was 10 years ago. And so there's more competition for every deal, which means they will continue, the best deals will continue to fill up very quickly. And as an investor, you will not see deals first or even 10th unless you are well positioned in a very specific space to see those types of deals first. If you go to golf in a foursome and people say, oh, well, what are you investing in? And you rattle off 10 different things, no one's going to remember any of them, and they're never going to show you anything first. If you say, I do hard money lending in the state of Texas, or I invest in stem cell companies in Austin and Silicon Valley, then people might show you that deal first, even if you're only a $1 million net worth investor. It's not about how much money you have. It's about how much they don't want to waste their time and how much they want to help the counterparty get the deal done and potentially be of value to you as well. So that's really important to remember. So one base thing to keep in mind here is that, and I got a link here from Kamal about the book. I'm happy to share those links here. I'll do that as I'm wrapping up and asking for questions. So you have to identify what we like to call your strike zone. If you're just looking at deals like, oh yeah, that sounds like a good deal. Yeah, that sounds like an interesting strategy. That's a little bit different than our other things. There's going to be pain and suffering that come from having, what's essentially a lazy approach to figuring out what you should invest in. I would recommend that you figure out the size of deal that's ideal, the size of the deal, which is ideal for you, the geography, do you need control or not? If you're investing passively through an HSA account, a health savings account, or a self-directed IRA, you have to be passive and at arm's length, et cetera. But some of your investments might be done in a control basis outside of your self-directed assets. what type or size of company do you want in terms of EBITDA, revenue, size of the team, how long you've known the team. Do you like income? Do you like things with collateral? Do you like debt? Do you like equity? Do you like convertible debt? Do you like preferred returns or gross revenue royalties? Do you like performance only fees? These are all different things that you need to figure out whether you like them or not, so you can instantly get rid of a lot of the deals you get sent. The whole goal is to be sent so many deals, you have to turn away 99% of them. If you're not doing that right now, then you're probably not investing in top 1% deals. It isn't possible, really, if you're not looking at 100 of those deals. We like to create one pagers of deal flow. I would say if you're worth something around $3 to $5 million and close to $10 million, you'll be there soon. It'd be a good exercise to create a Word document, document your strike zone, exactly what you're looking to invest in, put 7 or 10 bullet points describing what you're looking to invest in, save it as a PDF. Whether or not you have a brand for your family office or a brand for yourself at the top of the page is a little bit of a distraction. The most important thing is to communicate your strike zone. You could put that on a 2 to 3 page website or on a PDF. You could send that to people, and you could use that just as an exercise for you and your spouse or partner and family, so that when you do get asked while golfing or boating or at a conference, you're able to say with confidence what you're looking for, you know why you're looking for that, and you're very clear and intentional about communicating what your investment goals are. Here's some criteria that you can use for narrowing down the investments that you're looking for. It could be the number of years they've been in business. It could be that you want to restrict it to only 3 industries or 1 or 2 industries. Typically, I recommend that people focus, without knowing you personally, a template for thinking about this for many family offices is that if you focus on cash flowing real estate and maybe focus on 2 different types of real estate, 1 or 2 different types, and you focus on 1 geography or region, and then you look, some families, if they have enough wealth, might want to put 5 or 10% of their real estate allocation into real estate development and get more comfortable there. But then on a non-real estate side, typically families that are most successful that I see focus on 1 or 2 industries. And then that way there's synergies between their assets and things kind of build and stack on each other, and they get smarter and smarter over time. Here's the graph I mentioned earlier about standard deviations away from an average deal. You can see here that an average deal is basically the 40% of all deals you're seeing are truly average in almost every respect. You go away, 3 standard deviations and you're down to 0.1%. You go 2.5 standard deviations away and you're down to basically the top 1% of deals. But importantly, this goes in both directions. You could have a bottom 0.1% of all deals, but if you're only seeing 4 deals, you don't know that that is a bottom 0.1% deal. So one insight I've had is that the smartest families I know are non-apologetic about only investing their time and energy in the top 1% of deals. So they say no to things quickly and often, and that is their reality. They also are not scared to negotiate the structure they want. Somebody might suggest you invest as equity and you negotiate it as debt with equity warrants. Somebody might say that they are raising capital at a $3 million valuation, and you might say, well, I'll do the $3 million valuation, but I want a gross revenue royalty or a preferred return of X%. Or you say, well, I would only invest at this valuation. So if you can raise capital at that high valuation, more power to you. But we believe your valuation is 2 million, not 3 million. So let us know if you'd like to get the whole deal done. We can fill it at 2 million. But we see a lot of deal flow and we're sensitive about overpaying on valuation. So that's something that can be negotiated along the way, and more negotiation can happen than most investors realize. And when you see hundreds and hundreds of deals, you can afford to lose some if negotiations don't go well. You're indifferent to it. You're unemotional to it. The person raising capital wants to get it done. Maybe they're under stress of a timeline. Maybe they've approached many investors who've said no. Maybe it took them a while to find a strategic investor like you who actually understands their business. But you can afford to say no all day long, and they might not be able to afford to say no. So you can get good terms and better terms than most people are negotiating. Here's 10 different attributes of what I would define as an anomaly piece of deal flow, meaning this is one that really stands out from the rest. First of all, by the very definition, it can't be common. This can't be something that you see all of the time. And if you're reading this and you're participating today in this webinar and you are raising capital for something, then you can read these in a way of how does your deal need to be perceived to have any chance of surviving among a base of sophisticated investors. So one is it can't be common. Two is superior alignment. That means alignment in fees, alignment in legal structure, so that the person raising capital can't make a bunch of money before you make money, or you can't lose money while they're doing okay and making money. You also want to look for them having some pretend skin in the game where they might say, oh yeah, well, we're putting up 10% of the capital. But if they're using debt and they're only putting in 25% equity, 75% debt on, say, a $1 million deal, then that means there's 250,000 of equity going in, 750,000 of debt. And if they're charging a acquisition fee of 2%, and they're only putting in 10% of the equity, then that right there means that they're putting in, let's say, out of the $250,000, $25,000. But if they do a 2% acquisition fee on the total price of the asset, now they're getting $2,000 from that. They might have an asset management fee, and that asset management fee might be 2% a year. And those things might add up so that after 3 years or 5 years, they really have no risk in the deal at all. And meanwhile, you have $250,000 at risk in the deal. So I'd look out for that. That's the opposite of superior alignment. They always have to have a compelling team. Without that, it doesn't matter how good the idea is, unless you can buy the idea from them, put them on the advisory board, and take over the company or opportunity. Vertical or horizontally integrated. Oftentimes, this is part of how they are an anomaly and how they're different, how they de-risked or made the deal more exciting, but not always. Many times they dominate a niche. It could be a very small niche within a niche, but they might dominate the distribution channels, the IP, the patents. They might have a first mover advantage in the space. Owning choke points could be an attribute of an anomaly deal. They have something which just gives them an edge. It might not be dominating a whole niche, but they have one asset or one angle. It just gives them a flow of clients or a flow of capital into their deal. Oftentimes they're best in class or number one in something, and they're very clearly the industry leader in it. A lot of the time they have great momentum. We don't like to invest in startups. There's 1,000 angel investor clubs out there. We're not one of them. We like to invest in things that have climbed out of the ocean, grown some legs, and survived in the wild a little bit, and have learned how to actually make money. It's pretty easy to burn money. It's pretty easy to raise money for some idea that's going to transform the world. And there's a place for that. And the other 1,000 investor clubs are focused on helping those groups. We're focused on things that already are cash flowing, that already have money coming in, $1 million+ in revenue or millions in revenue. Some of the examples of things that we like to focus on would be like a $13 million medical device repair company, a multifamily property we bought last year, a dental clinic chain doing 1.5 million a month in revenue, medical chain we're vetting doing 8 million a year in revenue. Those are the types of things that we like to spend time on. Something that's exciting to learn about. If you just find yourself bored or just like losing interest, just move on, because it needs to be something that you are somewhat passionate about or excited about how unique and valuable the angle is that they're working on, and not confusing. So if you can't understand it, then maybe you ask a question or two just to make sure it's not something that you have been looking for, but otherwise just move on quickly. And if none of these things line up, just kill the deal immediately and just save yourself a few minutes of your life. You want to see a lot of deal flow. You don't want to investigate and conduct due diligence on a lot of deal flow. It's not possible to do due diligence on 400 deals in a year. Some of you only have time to do really thorough due diligence on 4 deals in a year. So you have to move on quickly if none of these things line up. If you have any questions, feel free to submit it in the chat or the Q&A panel. So how to position for deal flow. 1, you need a single sentence that summarizes what you're looking for. If I say we invest in medical and dental clinics that are doing $1 million plus in revenue and are based in the United States and have a 2-year operating history or more, that would be relatively clear. Also, it'd be even more clear if you said, we invest in dry cleaning businesses based in San Diego, doing $1 million plus revenue, because now it's more of a tight geography. That's something, and you want to state whether you're looking to acquire the business or invest passively or both when you can. Most investors say, oh yeah, we're looking for passive investments, or we're looking for cash flow investments, or we like real estate. And that's what people tell me even when they're worth 50 million or a couple hundred million, like, oh yeah, we look at everything. It's like, well, no, you don't. You don't want to invest in a Nigeria-based mobile app startup focused on tokenization of real estate, do you? Probably not. Nobody invests in everything. You're just wasting everybody's time when you say things that are essentially just a lazy description, and you haven't spent the introspection, you haven't spent the time meditating on exactly where you're going to get the best returns. So you're wasting your time and other people's time in real time. As you say it, you're wasting their time, and you're wasting future time because they're going to send you a bunch of junk that you would never invest in. And so a lot of families learn this the hard way. They invest in money and things and they get burned. A couple of things go well, they get burned again on something else. And they end up building these barriers to what they'll say no to, but don't spend a lot of time on being highly intentional of what they want to say yes to. And millions of dollars get burned in that process, or hundreds of thousands along the way. You want 100% strategic alignment if you can, with your knowledge, your wealth creation story, your team, your skill set, your insights, and then what you're actually allocating capital to. The exception to that is real estate. A lot of families like to have 25 to 40% of their capital in real estate. Not all investors, but a lot of them do like to have that for kind of sleep at night security of it being a hard asset and spread out with a number of different providers. You want to look at the branding of your small family office or your family office if you have one. It may not be appropriate to have that in place now, but where you're located, where your office is located, who's on your team, that's all going to change the access to deal flow that you get. If you're trying to invest in Austin, being based in Austin makes sense. Helpful resources for those selling. So if you really want to get a lot of deal flow, then you should have, and you are trying to attract deal flow in the manufacturing space, then having a manufacturing company valuation tool that you give away for free at a manufacturing association that costs $10,000 a year or $50,000 a year for membership will get you access to deal flow, because people interested in valuing their manufacturing company might be open to an investor. So it's a leading indicator to develop some helpful resource that's going to attract those that may be open for investment. The operating business we talked about earlier. If you're trying to invest in real estate and you're very serious about it and you're 10 million plus net worth, then you may want to have a real estate brokerage firm just so you see more deal flow, or a real estate valuation firm, or a real estate property management firm, or some sort of real estate platform online that produces a P&L itself that also gets you access to deal flow. My example for that was commercialrealestate.com, for example. You can attract investors, deal flow, and talent if you're positioned correctly. One thing we do for our positioning is draw out a blueprint. So we like to see a visual of what the industry looks like and where we're going to be positioned. And a great example of this is the dentist doctor niche. We do a lot. Out of the 375 investors we work with, around 100 are dentists and doctors. And what we do is we look at who do they trust, where do they go, where are they congregating, what do they need, and these are some things that we've put in place to penetrate the doctor-dentist space and help more of these types of investors. One is that we have formed a partnership with an association of 3,900 physicians, and we help their association at no cost, and we get access to their 3,900 doctors. Another one is we had an anesthesiologist within our InvestorClub. We wanted to work with more physicians and other anesthesiologists. So we tried to create a network for that little niche area with his help. Tried to get anesthesiology.com, but they wanted $2 million for the domain name. So we bought anesthesiologists.com, plural, and launched that website last week. And we got that for, probably, less than 5% of what the other person wanted for their domain name. So that was a good buy. It's probably worth a couple $100,000. We also have our Doctors Investor Club, is that niche within that area. We advise 72 different dentists through a separate investor club that another organization runs. We'll become a senior investment advisor to them. And we have other educational resources out there in the niche. So if you map that out, oh, here's an association, here's an advisor with 72 dentists, here's someone who's a member of our club and they know anesthesiology and they know that industry, and we could work with other people like them and he would like to work with us in that way. So here's a platform we can create that will draw more anesthesiologists to working with us. That's making a visual blueprint of how you're going to attract deal flow or build your position in a space. And if you're visual like I am, then you'll relate to that and you can map out how to get excellent deal flow. This could be as simple as join EO, join YPO, go to the Manufacturing Owners Association, speak at this event here and get on these 3 podcasts. And that could be it. And you could 10 times your deal flow just by doing those things, perhaps. So the other strategy I wanted to share today is one of my favorite ones about proactive data runs or proactive databases of potential assets you could acquire. This is a family office level idea, but anyone can use this. It's basically identifying what is the universe of businesses you could acquire. If you wanted to acquire gas stations in Seattle, and you said, well, I only like these certain suburbs or along, a certain freeway along I-5. And you say, okay, well, there are 92 gas stations in the target area. You have someone build an Excel spreadsheet of those 92 gas stations, try to figure out who the owners are by seeing if any are independent branded. Otherwise, look in county records to see who owns the real estate. It might be owning or leasing that land. Might have to go in person, you might have to make phone calls, you might have to send emails. Some niches are going to be harder to figure out who owns something versus others, but you build up a database and maybe out of 500 potential assets or 90 potential gas stations, you get contact details for 30 of those asset owners. And you have someone to help you with that research, put that in Excel, and then you work that like a system to build relationships and approach them saying, or you could send a letter and email and phone calls to those gas stations saying, I'm an investor, I'd like to buy your gas station. I'm also local, happy to meet anytime Tuesdays and Thursdays at 10 a.m. If you want a quick cup of coffee, I'll come by your gas station. We can just walk around the property real quick and just get to know each other so you can see that this is real and it's not a spam message sent out to 1 million people. I would make the message very short. I would put your picture on it. I would mention where your offices are if you're local and show that it's personalized. Like maybe you even say something about that specific gas station and say, I really like that you're at the corner of Scottsdale Avenue, and Shea Boulevard or something like that. So they know it's very personalized. And then you reach out to these 90 asset owners and you develop leads from them. So we've done this with a few different case studies with clients and ourselves. And one of them was 370 assets. We built a database of them, approached them, got on the phone with 70 of them. This was over a 9-month period. And we've closed on 4 investments from that effort. And we're negotiating our 5th investment right now, which will just be a small $250,000 investment, most likely. But this is a way to create deal flow for yourself that didn't exist for anyone else. And you're seeing it first. And many times, because people respond and say, oh, well, I don't know what my company is worth. I haven't thought about selling. Or, oh, well, it's funny you emailed me because I was thinking about maybe selling in a year or 2. So why don't we keep in touch and I'll come to you first when I am ready to sell and maybe it'll be easy to get it done. Or, oh, well, would you want to invest just partially? And then we get to know each other. And if that goes well, you could buy the whole thing. You'll create opportunities for yourself that you never would have known existed because they didn't exist for anyone else. And it's not going to have all the financial models worked out and financial statements updated and a pretty pitch deck. That's the value of finding these types of deals. I've had an investor complain about that before. And I said, oh, well, they don't have a deck and they don't have their finances in order. Like, yeah, that's because we just knocked on their door and asked to buy their business. But the fact that they responded saying, well, what do you think it's worth? Means there's an opportunity that we respond and say, hey, I think it's worth 2.5 times profits. And so we'll buy it from you for $1.6 million. When meanwhile, maybe you could buy that business, grow it a bit and sell it for 3.5 times profits. But getting better pricing is important and not overpaying is important. Seeing deals that others aren't fighting for, so you're not on a short timeline, is important. And most importantly, let's not forget, the only companies you're reaching out to are ones where you have a strategic advantage, you know the industry, you're local to it, you've self-identified that these companies most likely meet all of the check boxes in your strike zone. So spending 60%, 80% of your time on these proactive deal opportunities could be just a huge game changer for the types of deals you get done, the quality of deals you get done, the valuation at which deals you get done, and the creative terms you can come up with. For example, we're about to close our 7th gross revenue royalty deal where we invest money, and every month we get a payment out, a wire transfer off the top line revenue, meaning if someone does $100 in revenue, we get $3 every month back out. And we get that until we get 1.2, 1.5 times our money back. And then those payments drop way down, or they go away, or our equity gets reduced, or we just have our equity warrant now, and we don't have more payments after that. But that's a creative type investment term where if someone's already paid their lawyer $40,000 to structure their deal, and you want to have these creative terms, they might say, nah, we've already baked all this with a lawyer. I'm not going to go back and come up with some new structure just for you. So it's something to keep in mind. Jennifer's asking, will your books help us with going through the steps to be able to quickly identify the best deals suited for us individually? Jennifer, yes, the How to Start a Family Office book will help with that a bit. And, you know, I used to charge people $4,000 to $7,000 a month in retainer to help them set up their family office or get ideas on what deals to invest in. And I found that was a bad business to be in. So I don't do that anymore. So I'm happy just to help you for free. If you have questions over email, just send it to me. My email is richard@investorclub.com. And there's no cost to that. We don't like the consulting business model. So we've found that we just give away value to people, and maybe down the road some way there'll be a way to work together or an investment opportunity or something. But we're happy just to help you, even if we never do any business together otherwise. And Camaplan's been, you know, supportive of us, and I've really enjoyed getting to know Carl. So anyone who's, you know, a client there, happy to be helpful to you. But yeah, the How to Start a Family Office book will be helpful on defining your charter document for your private investments, your values, your mission objectives, and your strike zone. You also want to look for, when trying to get a lot of deals done, what I refer to as barrels of fish. So where are your prospects all congregating? Where are companies all getting together who have millions of dollars in revenue in the high-tech space or in the stem cell space, or whatever your niche is? It could be cosmetic surgery practices. Maybe there's only 2 really credible annual events and associations where all of them get together, and figure out where those are and speak at those events. Or like I like to do, I'll speak and give away a white paper or a book to everybody in the room, whether there's 700 people, 300 people, et cetera. And out of the whole event, last year I went to one event that had 120 speakers, 3,000 attendees. And out of the whole event, one other person had a book in the welcome bag. I was the only person that gave away a book live in the room while my talk was being given. And that was out of 120 speakers. So if you want to stand out, give somebody something that's not a sales brochure, give them something that's genuinely valuable. Like if we were in person right now, I would be giving all of you a handout on, here is a cheat sheet on how to double your deal flow, or here is a printout of the slides and a free copy of my book, How to Start a Family Office, et cetera. So that is something to keep in mind when trying to access more deal flow, is that it often congregates in a single area. Focusing geographically can just help make your life simple. I think all of us want to keep life simple, all else equal. You have to consider diversification. Do you want different types of real estate assets if you're going to focus only on one geography? Do you want to focus on 2 geographies to diversify a little bit, just in case one goes one direction, one goes another? For example, a high tax state versus a low tax state, or a Democrat versus Republican state, or places where migration could change and it could hurt you. Like some cities are very strong for real estate and have always been, like New York City. But then there are places like Florida and Arizona and Nevada that are getting a lot of net migration right now. But if you can make things very simple and say, we not only invest in Las Vegas, we only invest within a half mile of the strip in Las Vegas, and we only acquire multifamily properties in that area. That would be an example of focusing geographically. Not saying we invest along the East Coast or we invest in Texas. And not saying we invest in New York City. It'd be saying we invest between the streets of 55th and 65th Street, only within one block of Central Park. And we only buy X and Y. So the more you focus, the more that people will know what to send you, and the more that you can build a database or a universe of all the deals you could invest in that area. And it's just refreshing and freeing to restrict yourself to a small area of investment. And it could allow you to assemble multiple properties next to each other, which could be highly valuable to a developer one day. We're working on a few projects like that. We have a family with 30 acres in downtown Las Vegas, a family of 1,700 acres in Teton County, just outside of Jackson, Wyoming, a family with 1,500 acres on 80 different pieces of land. And we found families create a lot of wealth through the acquisition of connected parcels of land over time. Another way to double your deal flow is to build a deal finder network. I know someone who's became a billionaire from doing this. And they have 80 different people that they pay to find deals for them. If you're a smaller family, it might just be as simple as meeting with 5 real estate brokers in your local area and telling them exactly what you're looking for, along with your friends and other investor peers you know. So it doesn't have to be a massive network. It doesn't have to be a huge undertaking. A lot of us are trying to invest while working as an attorney or a business owner or a doctor. But having people out there keeping their antennas up for you is really important. If you can have 10 or 20 people that know exactly what you want to invest in, that's going to get you access to more deals. An example of a choke point, we had a billionaire family that had a drink company and they wanted to identify choke points for it. It wasn't coconut water, but let's just pretend it was. They could build an Excel database of coconut water companies and approach them, or people that distribute coconut water, and approach them about working together or investing. And let's say there's one website that just has all of the coconut water options available in the industry, or all of the drink and beverage distribution options as a distributor to wholesale buyers. And if they, as a family office, then invested and bought 10% of that website, they could push their product maybe through and get superior distribution, plus make money off the P&L of that website. That's a choke point. If there's a LinkedIn group of 20,000 food and beverage executives, they might be able to buy that or send a message out through that. There is actually a magazine called Drinks Magazine for some reason. I guess food and beverage people at restaurants read that. So you could, if you bought or created your own publication or bought 5% of the publication and invested in it, you could, again, push the distribution. The bottom example is at an expo, you could invest and either run your own event or invest in one. And even if you only own 1%, you could say, okay, I'll agree to your valuation, but I want to see the vendor list of everyone who has an exhibit table and get contact details for up to 10 of them before the event. And every year I want one booth in the front line row at 50% of what your cost is of normally having a booth. Now, when you invest in a company, you can give them frontline access for half the cost. You can get access to deal flow by seeing who the vendors are before they show up to the expo. And you can walk around the expo saying, yeah, I'm an investor. I'm one of the owners of this expo. And I could really help you in moving your consumer product forward. If you want to talk about an investment in your company, that will get you a lot of meetings for sure, no doubt. Many of you can't do all of those ideas. They're too expensive for the type of investor you are. But the idea is to teach you what a choke point is so that you could acquire ones that cost no money or are very inexpensive. Okay, so just to summarize, to double your deal flow, you need to have a strike zone, position yourself well, have a visual blueprint of where deal flow is, do a data run or a collection of 300 assets or 90 assets you could be acquiring and work that list, find barrels of fish, barrels of deal flow, focus geographically to an extreme point where you might only be looking to acquire assets on 4 different blocks, perhaps. Building a deal finder network was another idea that we brought up. So these aren't investments currently available, but just to give you an example of unusual deals in a good way, was we had a client that had 50 locations of a burger franchise brand, and they were adding another 50 to it. So together they'd be doing 100 million a year in revenue. That was pretty unique to see. In 14 years, I've invested in only one startup. That startup had a CEO who had grown that exact same business model to 100 million plus valuation in the exact same industry. And now he was doing it with 65% equity instead of 2% equity. and he's a CEO both times. It's very unusual to see that. You usually see a health tech company and the person used to be a doctor, or you see someone running a real estate business, but they used to work as a corporate executive and made good money, but then got into real estate, and then did more real estate, then syndicated real estate, and then created their own real estate firm. Many times they haven't done the exact same business model in the exact same niche. Those are just two quick examples of just things I like to look for that are not usual, and stood out to us, as being highly unique. We put together deal tracking dashboards for some clients. This can take a lot of work to keep updated though. We've started these for some and haven't updated them because the client either became inactive or they weren't using the dashboard. So it became a waste of time to keep it updated. Currently, the deal dashboard I've been using most is my whiteboard on the wall. We have 16 different deals that our various clients in our firm are looking at, and they're in different stages of due diligence. So it's either a lead or it's been pitched to us and shown to a counterparty. We are having a verbal agreement on what the terms could be as the next stage, meeting in person and kind of formalizing the agreement and starting to get the relationship strong enough. And then the last one is to paper and close the deal. And so by having that on the whiteboard on my wall, it helps me keep track of the different deals going on. But with working with clients virtually or working with an extended family, having it within something like Asana or a project management tool might help you track different deals you're looking at over time, because some you might want to get to know for 1.5 to 3 years, and you don't want to forget that they exist. So having those tracked could be very helpful. Okay, so that's it for my presentation here today. My email is richard@investorclub.com. If anyone has questions I'd like to ask privately. I'm also going to bring up my Dropbox here, and I'm going to get you guys links to a couple of those books and just share them in the chat, so you don't have to follow up over email to get the books. Let me get the link for you real quick. So this first book I'm sharing here is called Centimillionaire Strategies, which, don't let the word centimillionaire, which means $100 million net worth family, throw you. These are strategies that I use that you can use whether you're super ultra wealthy or not. And it has a lot of more details on some of the things we talked about today on the strategies that every $100 million net worth family should be using. But honestly, if you're a private investor, they almost all apply to you as well. They're just that much more painful if you're worth 100 million instead of 2 million. But I wanted to write one of the first books written for that audience. That's why we have that title to it. And then here's the book, How to Start a Family Office. And you might find that book helpful as well. Anyone have any questions before we sign off for today? So if you want to attend any of our events for free, nothing for sale there. You don't need to buy a membership. If you see anything about a membership for sale as a investor, it doesn't cost anything to come to our 20 live events a year. So feel free to look at familyoffices.com. Don't buy anything there. Don't buy a membership. That's for people raising capital. But if you want to attend any of those events that you see on familyoffices.com, like our Ultra Wealthy Investor Summit coming up on April 20th, just shoot me a quick email and we'll add you to the RSVP list for free. It's just richard@investorclub.com. And then we can RSVP you for a couple of our live events coming up, just so you can learn from other investors on stage and see what we talk about within our club. Thank you, everyone.
Thank you, Richard, and thanks everybody for joining. I hope you guys have a great rest of the evening.
Take care.